akamaliza hiyo story.
Na
Wan- Hmm?
Oshe.
It's been because I think nimenotice shida ni hiyo when you guys like Francis amekuwa very green, hata anashangaa ni nini. Mhm.
Jaribu kuingia kwa, acha ni hide kitu hapo. Ndio hapa.
Naona kuna 994. Hii umesema ilikuwa MT5. Nataka unaona
24.
hapo demo MT5. Na si na this is a demo MT5.
Oh shit, demo MT5. Oh man, sikuwa najua.
This is a demo MT5. So you use these loggings
Mhm.
kulogin kwa MT5 yako, okay?
Ngoja ngoja. Oh, e-logins. Okay, okay, okay.
So unachukua hiyo nini, alafu generate new password kama uko umeconnect account. And who was trading on it? Nataka u add funds hapo kwanza. Add
Mhm.
hapo $6. Nataka uanze ata nini? Nataka uanze at 1,000 flat. Yes, good.
Kwa hivyo iko sawa. Sikuwa
Yeah, that
nachukua
is
tu
okay.
hizi logins. Okay, okay, nice,
Yes,
nice.
so you log in those details kwa nini. Then I want you to be placing those trades. Be in the habit of placing those trades, okay?
Sawa.
Yeah. Hapo ndio utaanza ku identify like, okay, what am I doing? You'll actually know what you're doing. Oh, I see we have I see kuna mtu ametujoin, Steve. Mr. Steven. Oh, okay, okay. You lost your computer. It's okay. I hope you have I don't know if you've managed to do your account because we are starting the challenge. The challenge started today for doing it the practical way, pushing the button. It's okay, it's okay, it's okay. Confirm. Can you confirm with me if you've managed to join into
I can
GMC?
see, I can stop sharing, si ndio?
Yeah, yeah, yeah. You can now stop. It's okay. Mm, I can join on my phone if that would be better. It's okay. But you can now stop. It's okay. Mm, I wanna do this. I'm sharing the PDF now. Just a minute. Who is that? Okay. Steven, this is the book Trading in the Zone. If you can find it, a physical book, it's okay. I think it's around $3 on Amazon, if I'm not wrong. Trading in the Zone. Let me share the PDF in the chat. Okay, sent. Okay, you guys have seen the PDF. Then I'll open it. Mm, Let me share my screen. Tell me if you can see my screen. Can you see my screen, Alan? Alan, can you see my screen?
Yeah, I can see a screen.
Okay, so how we do the book club, we normally read together, okay?
Yeah.
We can decide to read it and break down paragraph by paragraph naweza kusema Kikuyu all, nasema all. Uh, or we read like a whole page, then we break it down just based on how you understand it, how I understand it. Okay.
Yeah.
So everybody can should be open to give a perspective, should be open to read it, should be open just to assist because it's a community thing. We are reading it together. For me, I'm already done with topic like almost the whole book, but I'm just repeating it over and over and over and over again. But I urge you as new beginners to do it because I know how helpful this is going to be in your journey when you guys read this. So, Alan, will you start
Yeah.
for us? Okay. So this is Trading in the Zone. You have to go to it's just a little bit of overview of the book. So we won't focus so much on here. You can actually see about the book, application, whatever, dedication. So just want to go directly to chapters. I want to go directly to chapter 1. Okay, there we go. Chapter 1. So I think we are good to go. We can start from here.
So I'm the one reading, yeah.
Yeah, you can start for us if you're comfortable.
Okay. Chapter 1, the road to success. Fundamental, technical, or mental analysis. And you start with the
So
beginning.
I just so just before you start, what does fundamental or technical or mental analysis mean? Like, what does it mean to you? Like anybody? What is fundamental?
Yeah. The basics, like fundamental.
Fundamental, the basics. Steven, are you able to open your audio? I don't know if your audio, you can unmute yourself. Okay, the basics. Technicals.
Maybe in
Technical.
fundamentals, let's say, okay, let's go to technical.
Uh-huh.
uh, Technical, a bit trickier.
Mm-hmm. Bit tricky. So we can just break it down to you. This is what we can actually do so that you guys see it. Let's just do it. Let's ask Copilot to help us immediately. The meaning of fundamental so that you guys can see. You guys can see my screen, yeah?
Yeah.
So this is the meaning of fundamental. Are you able to see?
Yes.
Okay. So I just wanted to be sure if you guys can see whatever I'm seeing. Serving as a basis of supporting existent or determining essential structure or function. A fundamental truth, belief, or concept, participation of citizen into fundamental democracy, therefore fundamental democracy, blah, 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 blah. I don't know if that made any sense.
Yeah.
Adhering to fundamentalism, a preacher who is evangelical, biblical, okay, fundamental change, also dealing in general principle rather than practical application. General principle rather than practical
Application.
application. Central importance, fundamental purpose, such as fundamental reverse, birth, importance, fundamental purpose. So, with all these, which one can we go with?
The first one.
The first meaning, serving as a basic supporting existent or determining essential structure or function. So, fundamental beliefs, you know, the market is shaped by emotions, by beliefs, by what people think. Okay.
Yeah.
Uh, Normally by emotions. So when we say the road to success, hapo nasema fundamental analysis. In trading, mostly focus so much on fundamental analysis. That's why sometimes we say fundamentals beat technicals. That is just to mean that fundamentals now in this case are the things that are happening currently. Like let's say today you hear that we have inflation. There's a news which is coming that there's an inflation. The government is increasing inflation. So normally, what you expect to do, you expect either people to react negatively or positively to the dollar. Okay, like when
Yeah.
there's a like when maybe there's a war, like there's an announcement that there's a war happening in Nini. So mostly, ideally, the basics mostly the real part is there will be panic, and most people will not invest. Most people will not do certain things. Okay.
Yeah.
So there's that part of what we call fundamental analysis in that part of the trading. Then there's the technical part. The technical part that is we're using now current technical part is we are using technical stuffs, that is numbers. We're using events, the way things have been. Okay. We are using
Yep.
math. We are using statistics, looking at now the one that we kind of teach you about knowing where supply areas are. psychological numbers. Okay, which year is it? What normally happened in this year? Blah blah blah. Here is a very strong demand area. We're expecting buyers. That is the technical aspect of it. Okay.
Yep.
Then the mental analysis. The mental analysis now is the psychology. It is the psychology part. Mental analysis now based on you yourself. Okay.
Yep.
What are you feeling? What are you thinking? What are your emotions? What are your current and need? What is your mind state? Okay. What are you feeling? Did you just disagree with somebody based on something? What is your belief about trading? Those are now about the mental parts. That is mental analysis, now the self. Okay.
Yeah.
Yes, yes. So I believe did break that down well. So you can continue.
Uh, in the beginning, fundamental analysis. So in the beginning, is that like from first, or that's another statement in the beginning?
I think it's just a sub nini because you can see
Yeah,
the
yeah.
those. Uh-huh.
Fundamental analysis. So I can start. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions? When I started trading in 1978, technical analysis was used by only a handful of traders who were considered by the rest of the market community to be, at the very least, crazy. As difficult as it is to believe now, it wasn't very long ago when Wall Street and most of the major funds and financial institutions thought that technical analysis was some form of mystical hocus pocus. Now, of course, just the opposite is true. Almost all experienced traders use some form of technical analysis to help them formulate their trading strategies. Except for some small isolated pockets in the academic community, the purely fundamental analysis is virtually extinct. What caused this dramatic shift in perspective? I'm sure it's no surprise to anyone that the answer to this question is very simple.
Uh-huh.
Money. The problem with making trading decisions from a strictly fundamental perspective is the inherent difficulty of making money consistently using this approach. For those of you who may not be familiar with fundamental analysis, let me explain. Fundamental analysis attempts to take into consideration all the variables that could affect the relative balance or imbalance between the supply of and the possible demand for any particular stock, commodity, or financial instrument. Using primarily mathematical models that weigh the significance of a variety of factors in bracket interest rates, balance sheets, weather patterns, and numerous others, the analyst projects what the price should be at some point in the future. The problem with these models is that they rarely, if ever, factor in other traders or variables. People expressing their beliefs and expectations about the future make price move, not models. The fact that a model makes a logical and reasonable projection based on all the relevant variables is not of much value in the traders who are responsible for most of the trading volume are not aware of the model or don't believe in it. As a matter of fact, many traders, especially those on the floors of the futures exchange who have the ability to move prices very dramatically in one direction or the other, usually don't have the slightest usually usually don't have the slightest concept of the fundamental supply and demand factors that are supposed to affect prices. Furthermore, at any given moment, much of the trading activity is prompted by a response to emotional factors that are completely the of outside the parameters of the fundamental models. In other words, the people who trade uh, and consequently move prices don't always act in a rational manner.
Mhm. Yeah, I believe this is just an introduction a little bit. I think most of the part is self-explanatory, so we're just going to continue this. True?
Yeah,
Oh no, did I just jump? Okay, there we go. Ultimately.
ultimately, the fundamental analyst could find that a prediction about where prices should be at some point in the future is correct, but in the meantime, price movement could be so volatile that it will be very difficult, if not possible, to stay in a trade in order to realize the objective.
Mm-hmm. Yeah, just for me, normally the first part is just trying to give you a bit of a perspective of what we tried to say, what is a fundamental analysis. And you realize that like in the years before when the market was there, like mostly people were relying just on the fundamental analysis. Okay.
Yeah.
Just based on the event news, inflations. That's how people were actually trading. Like, oh, there's a world war, so people are thinking this and this is going to happen. People will react to the market according to whatever is happening, according to whatever it's out there. But now this is the shift. So the shift to technical analysis. So this is the second part now I think is trying to explain about the technical analysis. And you guys can see how long trading has been happening. We are talking of 1970s and 19 going below.
Yeah, yeah, yeah.
Yeah. So you can continue if you still have the gas.
Uh, the shift to technical analysis.
Mhm.
Technical analysis has been around for as long as there have been organized markets in the form of exchanges, but the trading community did not accept technical analysis as a valuable tool for making money until the late 1970s or early 1980s. Here is what the technical analyst knew that it took the mainstream market community generations to catch on to. A finite number of traders participate in the markets of any given day, week, or month. Many of these traders do the same lines of things over and over in their attempt to make money. In other words, individuals develop behavior patterns, and a group of individuals interacting with one another on a consistent basis form collective behavior patterns. These behavior patterns are observable and quantifiable, and they repeat themselves with statistical reliability. Technical analysis is a method that organizes this collective behavior into identifiable patterns that can give a clear indication of when
Mhm.
there is a greater probability of one thing happening over another. In a sense, technical analyst allows you to get into the mind of the market to anticipate what is likely to happen next based on the kind of patterns the market generated at some previous moment. As a method for projecting future price movement, technical analysis has turned out to be a far superior to a purely fundamental approach. It keeps the traders focused on what the market is doing now in relation to what it has done in the past instead of focusing on what the market should be doing based solely
That word, solemnly. Okay. Solemnly speaking.
solely,
Yeah.
yeah, on what is logical and reasonable as determined by a mathematical model. On the other hand, fundamental analysis creates what I call a reality gap between what should be and what is. should be and what is. The reality gap makes it extremely difficult to make anything but very long-term predictions that can be difficult to exploit even if they are correct. In contrast, technical analysis not only closes this reality gap but also makes available to the trader virtually unlimited number of possibilities to take advantage of. The technical approach opens up many more possibilities because it identifies how the same repeatable behavior patterns occur in every time frame.
Oh, I
Moment
hear people. I always wonder
moment to moment, daily, weekly, yearly, and every time span in
if
between. In other words, technical analysis turns
can
the
you hear me,
market
Mr. David?
into an endless stream of opportunities to enrich
Mr.
oneself.
David, you can hear me?
Yeah, we can hear you, Stephen.
Okay.
Yeah,
Sorry, it took me a long time to find a headphone.
it's okay.
Okay. Okay, I'm here though. Yeah.
Okay, okay.
Yeah.
Uh-huh. So, I believe, Mr. Alan,
Yeah.
I believe the technical part kind of did stick in. I don't know if maybe, or how do you break down that, whatever you've just read?
Um,
What are you getting from it?
let's say we are told here that
Mhm.
one can get to know how the market moves and
Mhm.
yeah.
Yeah, so actually it's not that big. It's only that the book is just trying to show you now how did the shift happen and why now technical analysis is the king. Okay?
Yeah.
Yeah, because this is now based on analysis on how people behave, on how a certain amount of predators, like areas of where these people do, and you're able to take these patterns and be able to refer them to the future. Like we use the past to determine the future, which that's how really we collect data. That's how we do everything in life. True. For us to
Yeah.
know like when to plant, when to harvest, when to prepare our farms, when to like to find maybe in the US those ventilators, whatever, those warmers, when to use certain things. We need to have seen a repeated season of what has always been happening. That's why we are able to tell, like, okay, uh, June to August, we normally have a rainy season. From this to this, we normally have summer. From this to this, we normally have. So that is just basically we are using the past to determine to be able to see how the future likely might come. And by that, normally it's usually around the percentages of accuracy, it's normally high. So that's why technical
Yeah.
analysis is the king right now in the market.
Mm-hmm.
Yeah. Okay.
Okay.
Yeah. The
Yeah.
technical approach opens up. Mhm. Okay. Did you finish this part?
Yeah.
Okay, so we can go to the shift to mental analysis. So we started with fundamental, technical. Now we are on the shift. Now we are talking of the mental analysis. So you can just finish up. Then maybe if Stephen is able to take us through the next, we can be able
Yeah.
to read two more pages, and then we can call it a day.
Okay.
Okay.
Mhm.
The shift to mental analysis. Hmm. If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves, meaning their own individual trading psychology? To answer this question, you probably don't have to do anything more.
Yes. So, wow. Uh, so technical, if we have fundamental and then we shifted to technical analysis and it's working, why now do we have to focus on our own psychology? Like this is literally why we're even studying this book. And this is why now this areas is going to really make you understand why I focus so much on working on your psychology. And I told you skills is 5%, 95% is mindset. Okay.
Yeah.
Yeah. So you can continue, Mr. Alano. Yeah,
Then
when you
ask
want,
yourself,
Mhm.
huh?
When you want assistant, you can just say, then somebody else is gonna take over.
Okay.
Mhm.
Then ask yourself why you bought this book. The most likely reason is that you are dissatisfied with the difference between what you will perceive as the unlimited potential to make money and what you end up with on the bottom line. That is the problem with technical analysis. If you want to call it a problem, once you learn to identify patterns and read the market, you find there are limitless opportunities to make money. But as I'm sure you already know, there can also be a huge gap between what you understand about the markets and your ability to transform that knowledge into consistent profits or a steadily rising equity curve. Think about the number of times you have looked at a price chart and say to yourself, it looks like the market is going up or down as the case may be. And what you thought was going to happen actually happened, but you did nothing except watch the market move while you anguished over all the money you could have made. There's a big difference between predicting that something will happen in the market and thinking about all the money you could have made, and the reality of actually getting into and out of trades. I call this difference, and others like it, a psychological gap that can make trading one of the most difficult endeavors you could choose to undertake, and certainly one of the most mysterious to master. The big question is, can trading be mastered? It is possible to experience trading with the same ease and simplicity implied when you are only watching the market and thinking about success as opposed. And thinking about success as opposed to actually having to put on and take off trades. Not not only is the answer and unequivocal, yes, but that is also exactly what this book is designed to give you: the insight and understanding you need about yourself and about the nature of trading. So the result is that actually doing it becomes an easy, simple, and stress-free as when you're just watching the market and thinking about doing it. This may seem like a total order, and to some of you, it may even seem impossible, but it is not. There are people who have mastered the art of trading, who have closed the gap between the possibilities available and their bottom line performance. But as you might expect, these winners are relatively few in number compared with the number of traders who experience varying degrees of frustrations, all the way to extreme expiration, wondering why they can't relate the consistent success they so desperately desire. In fact, the differences between these two group of traders, the consistent winners and everyone else, are analogous to the difference between the Earth and the Moon. The Earth and Moon are both celestial bodies that exist in the same solar system. They do have something in common, but they are as different in nature and characteristics. Um, but they are as different in nature and characteristics as night and day. But the same token, anyone puts on a trade can claim to be a trader. But when you compare the characteristics of the handful and consistent winners with the characteristics of most other traders, you will find they are also as different as night and day.
Mhm. Yeah. So I don't think we need any breakdown of that.
Yeah.
It's so
Yeah.
as simple as like that. So we're still breaking down the book. I love this book because of this.
Mhm.
Uh yeah. So Alan, you want to continue? Or you want somebody to take over?
Steve can take it.
Okay.
Okay.
Yeah. If going to the moon represents consistency, success as a trader, we can say that getting into the moon is possible. The journey is extremely difficult, and only a handful of people have made it. From our perspective here on Earth, the moon usually visibly visible every night and seems close that we could reach out and touch it. Trading successfully feels the same way. On any given day, week, or month, the market makes available vast amounts of money to anyone who can have the capability to put on a trade. Since the market are in constant motion, this money is only consistently following, which makes the possibility for success greatly magnified and seemingly within your grasp. I use the word seemingly to make a very important distinction between the two groups of traders. For those who have learned how to be consistent and have broken through what I call threshold of consistency, the money is not only within their grasp, but they can virtually take it at will. I'm sure that somebody will find this statement shocking and difficult to believe, but it is true. These are some limitations, but for the most part, money flows into the account of these traders such as with such ease and effortless that it literally boggles most people's mind. However, for the trader who have not evolved into these select group, the word seemingly seems exactly what it implies. It seems as if consistency or ultimate success desire is at hand or within their grasp just before it slips away or evaporates before their eyes time and time again. The
Let me move it.
okay,
Okay, there we go.
okay. The only thing about trading that is consistent with the groups is emotional pain. Yes, there certainly have been moments of elation, but it is not an exaggeration to say that most of the time they are in a state of fear, anger, frustration, anxiety, or disappointment, betrayal, regret. So, what separates these two groups of traders is intelligence. Are the consistent winners just plain smarter than everybody else? Do they work harder? Are they better at analysis? Or do they have access to better trading systems? Do they process inherent personality characteristics that makes it easier for them to deal with the intense pressure of trading? All of these possibilities sound quiet, plausible, except when you consider that most of trading industry's failure, also some of society's brightest and most accomplished people are the larger groups of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Furthermore, most of the industry's best market analysis are the worst traders imaginable. Intelligence is very good. Market analysis on the road to success certainly contributes to success, but they are not defining factors that separate consistent winners from everybody else. Well, if is it intelligence or better analysis, what could it be?
So, anybody want to break it down from
Uh,
what you're getting from this? Mhm.
yeah, I think the difference between very successful traders is they're consistent with everything. It seems like it's not just trading. They're consistent with their mind space. Maybe
Mm.
they know how to control their emotions every day. It may be how they go about life is consistent. Because it seems the ones that have too much emotion, too much frustration, it seems like they lose the focus.
Um, wow, amazing. You have something, Nani, Alan?
Nah, it's only what Steve just said. I think it is that way.
Mhm. Yeah, actually, for me, the points that normally kind of have kind of tried to do my own research and try to see this part that it says you find that most people who are struggling so much in this case in the trading industry are the people we so call the intelligent, like the society has labeled them as intelligent, you know? Somebody who has gone to school, has studied like doctor for 5, 7 years. They have been successful in it. Engineers, these big, huge guys. You find them when it comes to trading, they are a bit struggling in it. And it's not because of the intelligence of or whatever they're doing. It is because of the ego that comes out from it.
Mm,
So because they're like, okay. So first of all, there's a belief that it is inside them that you need to do these and these and these and these in order to make such and such and such money. You get it? So they're battling that belief again. So they're trying to bring that intelligence into what? Into trading, which the market doesn't reward intelligence. The market doesn't reward. The market rewards discipline, consistency. Okay. So
yeah,
you're actually going to find, I think the book breaks it down and you're going to see how the road is. So it's super awesome. This book is just super awesome. I love it. I love it when I keep on reading it because it reflects directly to our trading journey and what the society has. So
yeah.
where are we? Uh-huh. Stephen, where did you reach?
Oh, I think
Forgot.
is 4 month. I think right here, 4 month.
Yeah, yeah.
Furthermore,
Mhm.
furthermore,
Yes.
furthermore,
Mhm.
furthermore, most of the industry's best market analysis is the worst trader imaginable. Intelligence is good for market analysis on the road to success, but are not the defining factors of the consistent winners like everybody else. But if it's intelligence or better analysis, then what could it be? Having worked with some of the best, some of the worst traders in the business, I'm ha- I have, and having helped some of the worst become some of the best, I can state without a doubt that there are specific reasons why the best traders consistently outperform everybody else. If I had to distill all the reasons down to one, I would simply say that the best traders think differently from the rest. I know that it doesn't sound very profound, but it doesn't have a profound implication if you consider what it means to think differently. To one degree or another, all of us think differently from everyone else. We may not always be mindful of this fact, but it seems natural to assume that people share our perspectives and interpretations of events. In fact, this assumption continues to seem valid until we find ourselves in a basic fundamental.
Mhm.
Disagreements with someone about something we both experience, other than our physical features, the way we think is what makes us unique, probably even more unique than our physical features do. Let's get back to traders. What is different about that way the best traders think as possible? I think as opposed to how those who still struggling think. While the market can be described as an area of endless opportunities, they simultaneously confront the individual with some of the most sustained adverse psychological conditions you can expose yourself to. At some point, everyone who trades learns something about the market, and that will indicate when opportunities exist. But learning how to identify opportunity to buy or sell does not mean you have learned to think like a trader. The defining characteristics that separate the consistent winners from everyone else is the winners that have attained a mindset unique, a set of attitudes that allow them to remain disciplined, focused, and all above, and above all, confident in spite of adverse conditions. As a result, they no longer susceptible susceptible to the common fears and trading errors that plague everyone else. Everyone who trades ends up learning something about the market. Very few people who trade ever learn the attitudes that absolutely essential to becoming a consistent winner. Just as people learn to be perfect, the proper technique for swinging a golf club or a tennis racket, the consistency or lack of it will without a doubt come from the attitude traders who make it beyond the threshold of consistency usually experience a great deal of pain, both emotional and financial, before they acquire the land of attitude that allows them to okay that allows them to function efficiently in the market environment. The rare expectations are usually those who were born into successful trading families who start their trading careers until the guidance someone who understood the true nature of trading and just as important knew how to reach it. Why are emotional pain and financial pain disasters common among traders? The simple answer is that most of us weren't fortunate enough to start our trading careers with the proper guidance. However, the reasons go much deeper than this. I have spent the last 7 years dissecting the psychological dynamics behind trading so that I could develop effective methods for teaching the principal of success. What I've discovered is that trading is a chock full of paradox and contradictions and thinking that make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates, oh, I was not good at ELA class, English class.
It's okay. But you're a good reader, man.
I'm trying, yeah, it
Yeah. Mhm.
encapsulates the nature of trading. It would be paradox. According to the definition of paradox, is something that seems to have contradictory qualifies or that is contrary to common belief and what generally makes sense to people. Financial and emotional disaster are common among traders because many of the perspectives, attitudes, and principles that otherwise would make perfect sense and work quite well in daily lives have the opposite effect in the trading environment. They just don't work. Not knowing this, most traders start their careers with a fundamental lack of understanding of what it means to be a trader. The
Yeah, just a minute, sorry.
no problem. Okay. The skills that the skills that are involved in the depth with those skills need to be developed. Here is a prime example of what I'm talking about. Trading is inherently risky to my knowledge. No trade has guaranteed outcome. Therefore, the possibility of being wrong and losing money is always present. So what you put on a trade can consider yourself a risk taker. Can you consider yourself a risk taker even though this may sound like a trick question, is not? The logical answer to the question is unequivocally yes. If you have engaged in this activity that is inherently risky, then you must be a risk taker. This is the perfect reasonable assumption for any trader to make. In fact, not only do virtually all traders make the assumption, but most traders take pride in thinking of themselves as a risk taker. The problem is that this assumption could make this assumption could make
It
uh,
couldn't be further.
okay.
Yeah.
Oh, wait a second. Hold on, mommy. I'm in class. Okay, hold on. I call you back. Okay, so this can you help me, Tonto, where I was at?
Okay, this assumption.
Yeah. This problem that this assumption can be further from the truth. Of course, any trader is taking a risk when you put a trade, but this doesn't mean that you are correspondingly accepting that risk. In other words, all trades are risky, but the outcomes are probable, not guaranteed. But do most traders really believe that they are taking a risk or they are putting on a trade? Have they really accepted that the trade has a non-guaranteed probable outcome? Furthermore, have they fully accepted the possibility of the consequence? The answer is unequivocally no. Most traders have obviously no concept of what it means to be a risk taker. And in a way, successful traders think about risk. The best traders not only take risk, but they also have learned to accept and embrace the risk. There is a huge psychological gap between assuming the risk you are a risk taker and because you put trades, but in fully accepting the risk inherited from each trade. When you fully accept the risk, it will be profound implications on your bottom line performance. The best traders can put a trade without the slightest bit of hesitation or conflict, just as freely and without hesitation or conflict admit it isn't working. They can get out of a trade even with a loss, and doing so doesn't resonate the slightest bit of emotion or discomfort. In other words, the risk inherent in trading does not cause the best traders to lose discipline, focus, a sense of confidence. If you are unable to trade without the slightest bit of emotion, discomfort, specifically fear, then you will have not learned how to accept risk inherent of trading. This is a big problem because to whatever whatever degree you have having accepted the risk is the same degree to which you avoid the risk. Trying to avoid something that is unavoidable will have disastrous effects,
Disasters.
okay, on your ability to trade successfully. Learn to truly accept the risk in any endeavor that can be difficult, but it is extremely difficult for traders, especially considering what's at stake. What are we generally most afraid of? Besides dying or publicly speaking, certainly losing money or being wrong, both rank close to the top of the list. Admitting we are wrong and losing money to boot can be extremely painful and certainly something to avoid. Yes, yet, as traders, we confront these two possibilities virtually every moment we are in a trade. Now you might say to yourself, apart from the fact that it hurts so much, it's natural to not want to be wrong losing something. Therefore, it's appropriate for me to do what I can to.
Oh no, I jumped.
It's
Oh no.
okay.
Yeah, I think.
Okay, admitting we were wrong and losing money to a boot could be extremely painful and certainly something to trade. Now you might say to yourself, apart from the fact that it hurts so much, it's natural to avoid it. I agree with you. But I also have a natural tendency that makes trading, which looks like it should be easy, extremely difficult. Trading presents us with a fundamental paradox. How do we remain disciplined, focused, and confident in the face of consistency and uncertainty? When you have learned how to think like a trader, that's exactly what you will be able to do. Learning how to redefine your trading activities in ways that allows you to completely accept the risk is the key of thinking like a successful trader. Learn to accept the risk in trading skills. More importantly, the skills you can learn. Yet it is fair that you develop traders focus. Okay. Any
Yeah, so just maybe give you room to breathe a little bit. So I think most of this
yeah,
is we're just starting. You can actually see how the book is breaking it down, and I love it
yeah,
how it's guide. It's telling you like trying to relate the society and everything. And for me, whatever we've just read there, it's the exact reason why you find it is a difficult thing for these the so-called intelligent individuals in society to be successful in this, because them accepting the paradox, accepting that, because all their life they've been taught to take control, like they're in charge. So when you're going to tell them that this is a 50-50%, they'll not accept it. You get it? They always
Yeah.
like want to force it. They want always to be right. They want to force things. So you find somebody is
yeah.
on trade, but will never like push the button and call it okay. This is a loss.
Mhm.
Okay.
Yeah.
Yeah.
Yeah. So unless somebody has a different opinion on that, or just an addition.
I feel like too. He's saying like, yeah, you have to be ready for any outcome, but you also have to be confident in your choice. You can't hesitate, even if
Yeah.
you could be wrong. You gotta be okay with
Mhm.
being wrong too.
Yes.
Yeah, yeah.
Well, yeah, that is a very powerful point. Being okay with being wrong. and don't beat yourself for that. Yes, very true.
Yeah.
Learning to
Oh,
accept the risk. Okay.
quick question, Tonto.
Uh-huh.
Is there a way I could start, like I could buy on TradingView, like so I could practice trading without doing live account?
No, no, no. You're not going to do a live account. You're going to do a paper money. That is a demo.
Okay. Okay.
Yeah, you're not going to you're not going to do a live. I'm going to show you actually how to practice it on a demo, on a paper money,
Yeah.
not on a live money. Okay?
Yeah. Also, if you have time,
It,
if not after this or a different day, if you could just watch me for like 10 minutes, just do a whole markup and just correct me if I'm wrong.
yeah, absolutely. That is what we are. I was just thinking, and I'm going to do that with you guys. Every day,
Okay.
somebody different will be doing a markup.
Okay.
Like we jump on a call,
Yeah.
Alan does a markup next day,
Okay.
so we're going to do it. And I think after this, I'm going to help you to set up that demo account.
Yeah. Yeah.
Yeah. Okay.
Okay.
So what page are we on? We are on page 22. You're suggesting we go up to page what?
Mm, shoot. It's up to you, Alan. How you feel? Me, I can go to maybe 25 or 30. I don't know. I don't want to. I know it's late for you guys.
Yeah.
Yeah, I know it's late, bro. It's late.
What does yeah mean, Alan?
It is late.
Yeah.
So what page? I've not answered.
I just said page 22.
Which page?
25.
Okay.
Okay, okay, 25. Okay. You think you've selected less? Oh no.
Oh, why?
Okay, let's see. Uh-huh. Okay, so Stephen, you want to continue or you want to pause a little bit?
I Aled, I give you this page. I read after this page. Give me a quick pause. Quick pause.
Okay.
Okay, let's see.
Okay, when you learn the trading skill of risk acceptance, the market will not be able to generate information that you define or interpret as painful. In the information the market generates doesn't have the potential to cause you emotional pain. There is nothing to avoid. It is just information telling you what the possibilities are. This is called an objective perspective, one that is not skewed or distorted by what you are afraid is going to happen or not happen. I'm sure there isn't one trader reading this book who has not gotten into trades too soon, before the market has actually generated a signal. Long after the market has generated a signal, what trader has not convinced himself not to take a loss and, as a result, had it turn into a big one, or got out of winning trades too soon, or found himself in winning trades but did not take any profits at all, and then let the trades turn into losers, or moved stop losses closer to entry point, only to get stopped out and have the market go back in his direction. These are but a few of the many errors traders perpetuate upon themselves time and time again. These are not market generated errors. That is, these errors do not come from the market. The market is neutral in the sense that it moves and generates information about itself. Movement and information provides each of us with the opportunity to do something, but that's all. The markets don't have any power over the unique way in which each of us perceives and interprets this information, or control of the decisions and actions we take as a result. We take as a result. The errors I already mentioned are many more and strictly the result of what I call faulty trading attitudes and perspectives. Faulty attitudes that foster fear instead of trust and confidence. I don't think I could put the difference between the consistent winners and everyone else more simply than this. The best traders aren't afraid. They aren't afraid because they have developed attitudes that give them the greatest degree of mental flexibility to flow in and out of trades based on what the market is telling them about possibilities from its perspective. At the same time, the best traders have developed attitudes that prevent them from getting reckless. Everyone else is afraid to some degree or another. When they are not afraid, they have the tendency to become reckless and to create the kind of experience for themselves that will cause them to be afraid from that point on. 95% of the trading errors you are likely to make, causing money to just evaporate before your eyes, will stem from your attitude about being wrong, losing money, missing out, and leaving the money on the table. What I call the 4 primary trading fears. Now you may be saying to yourself, I don't know about this. I've always thought traders should have a healthy fear of the markets. Again, this is a perfectly logical and reasonable assumption. But when it comes to trading, your fears will act against you in such a way that you will cause the very thing you are afraid of to actually happen. If you are afraid of being wrong, your fear will act upon your perception of market information in a way that will cause you to do something that ends up making you wrong. When you're fearful, no other possibilities exist. You can't perceive other possibilities or act on them properly, even if you did manage to perceive them, because fear is immobilizing. Physically, it causes us to freeze or run. Mentally, it causes us to narrow our focus of attention to the object of our fear.
So I think let me just help you guys. I think we're going to finish on on this page, okay?
Yeah.
Yeah, because these pages are usually very long. Long. This means that thoughts about other possibilities as well as other available information from the market get blocked. You won't think about all the rational things you've learned about the market until you are no longer afraid and the event is over. Then you will think to yourself, I knew that. Why didn't I think of it then? Or why couldn't I act on it then? It is extremely difficult to perceive that the source of this problem is our own inappropriate attitudes. That's what makes thinking patterns that adversely affect our trading are a function of the natural ways in which we are brought up to think and see the world. These thinking patterns are so deeply ingrained that it rarely occurs to us that the source of our trading difficulty is internal, derived from our state of mind. Indeed, it seems much more neutral to see the sources of a problem as external in the market because it feels like the market is causing our pain, frustration, and dissatisfaction. Obviously, these are abstract concepts, and certainly not something most traders are going to concern themselves with. Yet, understanding the relationship between beliefs, attitudes, and perception is as fundamental to trading as learning how to serve to tennis, or as learning how to swing a club is to golf. Put another way, understanding and controlling your perception of market information is important only to the extent that you want to achieve consistent results. Okay. I say this because there is something else about trading that is as true as the statement I just made. You have to know the proper way to swing a tennis racket or golf club in order to hit good shot from time to time. The first time I played golf, I hit several good shots throughout the game, even though I hadn't learned any particular technique. But my source was still over 120 over 18 holes. Obviously, to improve my overall score, I needed to learn technique. Of course, the same as true for trading. We need technique to achieve consistency. But what technique? This is truly one of the most perplexing aspects of learning how to trade effectively. If we weren't aware of or don't understand how our beliefs and attitudes affect our perception of market information, it will seem as if the market's behavior that is causing the lack of consistency. As a result, it will stand to reason that the best way to avoid losses and becoming consistent will be learn more about the markets. This bit of logic is a trap that almost all traders fall into at some point, and it seems to make perfect sense, but the approach doesn't work. The market simply offers too many often conflicting variables to consider. Furthermore, there are no limits to the market behaviors. It can do anything at any moment. As a matter of fact, because every person who trades is a market variable, it can be said that any single trader can cause virtually anything to happen. This means that no matter how much okay, we're going to end it here somewhere. No matter how much you learn about the market's behavior, no matter how brilliant an analyst you become, you will never learn enough to anticipate every possible way that the market can make you wrong or cause you to lose money. So if you are afraid of being wrong or losing money, it means you will never learn enough to compensate for the negative effects these fears will have on your ability to be objective and your ability to act without hesitation. In other words, you won't be confident in the face of constant uncertainty. Okay, so I believe we're going to end it here. Are you all with me? Ama nilibaki peke
Yeah.
yangu?
Yeah.
Yes. Any last remarks based on
No,
what we've just an overall overview about the book?
no, it sounds good. Everything's good. Do you have time today, Mr. David, to look at my markup, or if it's okay, better for you a different day, I can wait.
On your markup, we're going to do it tomorrow. Is Thursday. We're going to do it tomorrow. Okay.
Okay. Yeah. Sounds good.
Okay.
Okay.
Okay. So there is this. Okay. So we're going to do it tomorrow. Alan,
Okay.
you have something?
I'm good.
You're good. Oh, you said you're good. I was still waiting for you to say to say something. Okay. So generally, actually, the reason why I'm making you guys do this is because I don't want you guys to go back and do this later. You can actually see that the book is talking about people who have already gone into the trading aspect. They've already encountered those challenges. So it's when they're going back to the book. Okay.
Yeah.
But if you can be able to anticipate, read this thing and understand, get the concept, you'll be able to reflect it in the market. You'll be able to see it. You'll be like, oh, this is what I was reading, and this is what obviously is happening to me. I entered this trade. Why do I want to get out of this trade before?
Mhm.
The fear of missing out. We call it FOMO. In trading, we call it FOMO. Just because you saw David in the morning and posted that I'm already up 100, so somebody's like, I want to also take that buy and continue. Then you enter and you find yourself that fear of missing out. You entered and you're in deep drawdown. Okay.
Yeah.
Yeah, so those are the kind of things, emotions, the discipline that you need to be aware about. And actually, the book has even said there, you're never going to learn enough about trading. You'll find yourself in a rat hole trying to go deep and deep and deep and deep and deeper. You just always want to know, always want to know, always want to know. Actually, you can just know 2 or 3 things about the market and stay consistent with it, and the market is going to reward you.
Yeah.
You can just supply and demand, support and resistance, those kind of things, and the market is going to reward you. You don't need to know way, 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 way more, because it will now cause that analysis paralysis. You always want to learn, you always want to, and you find yourself, you're trying to dig, and the moment you're digging, you're doing nothing with it. That's why I said, stop. Let's make you guys start practicing what you have,
Yeah.
start knowing what you have. Actually, I was astonished even today by jumping with one of your friends, and they were like, they don't know nothing about, they have never even pushed a button, they don't even know like how a demo, what is it, what, and I was like, what, you were doing the wrong thing. We really need to make you guys practice.
Okay.
Okay,
Yeah.
so that being said, Steven, share your screen.
Okay.
I help you set up your demo now.